Welcome to Regulatory Ramblings. Our podcast today is brought to you by the University of Hong Kong's RegTech Lab, the HKU SCF Fintech Academy, the Asia Global Institute, and HKU edX's Professional Certificate in Fintech, with support from the university's Faculty of Law. Our guest today is a dear friend of HKU Fintech, as well as an alumnus of this fine institution. Syed Musheer Ahmed, or Musheer as we've known him, has over 18 years of experience as an ecosystem builder in capital markets, fintech, and virtual assets, including a decade as a global markets trader prior to attaining his MBA from the University of Hong Kong and London Business School. Since 2016, Musheer has contributed extensively to building the fintech and virtual asset ecosystem in Asia, particularly as the co-founder and board member and inaugural general manager of the Fintech Association of Hong Kong. For the past 4.5 years, he's been the managing director of Finstep Asia, a firm which he founded. In that capacity, he's helped launch cross-border programs for fintech firms to scale and to go to market across the region. He's also served as an external consultant to the Bank for International Settlements, BIS, Hong Kong Innovation Center, as a program lead on Project Genesis 2.0, tokenization of carbon credits appended to green bonds. In addition, he's been an advisor to the Stellar Development Foundation for their partnership development in APAC markets. And he's served in an advisory role to regulators and policymakers in Asia and the MENA region, Middle East, North Africa, on fintech, CBDCs, and blockchain policy. And as a topic that's dear to our hearts, the role of women in fintech. He has been an advisor to the Financial Alliance for Women on Fintech, serving women's economy, and they conducted to date the largest research with 200 startup groups globally, while enabling the conduction of the annual hackathon competition for 3 years. He's also delivered research and reports on fintech, digital green finance, regtech, CBDCs, blockchain for both large and small startups and regional regulators alike. And his firm Finstep Asia is the organizer of large-scale events in fintech and blockchain, which is the VFF forum with over 20,000 participants from 100 plus countries. Musheer also has seen things from a regulatory standpoint. He's been a former regulator, having done a stint between October of 2022 and this past January, as the Financial Markets Risk Assurance Lead at the Virtual Assets Regulatory Authority in Dubai, the first regulator of its kind. And with that, Musheer, thank you so much for joining us.
Thank you, Ajay, for having me on the podcast, and to HKU RegTech Lab as well. It's an honor being on this fantastic podcast. I've been listening to yourself and the guest over the last several months, and it's a delight to be here.
Thank you. I mean, we wanted to have you on for a while. It's fortuitous that it finally happened. So tell us a little bit about yourself. I mean, where are you from originally, and what brought you to fintech and crypto? I mean, I know you're from Bangalore originally, the tech city of India, but fill in the gaps, fill in the details for us.
Sure, thank you. As you mentioned, I'm born and raised in Bangalore, multi-generation from Bangalore. I did my engineering as an industrial engineer, going on to then take my first steps in finance as a fixed income futures trader, trading what is known as $0 futures, right? The one metric that makes a lot of the world run, or used to, which is the LIBOR futures, which are essentially interest rate applicable for dollars traded outside of the US. So that was like an introduction to finance and how things move. I could almost as well say that this was fintech because I was an electronic trader, right? I was using technology extensively, for my trading, from charting to trying to use some algorithms when we were trading. I spent 9 years with the company. It's called Futures First in India, but it's headquartered in UK and known as GH Financials as a parent company of the organization, also known as now Thurston Group, right? Spent 3 years of my 9 years in Mauritius, building up the company's branch there and having traders who were trading in the markets for commodities as well as oil futures. And there was a fantastic time. Roughly about 10 years ago, I moved to Hong Kong to do my MBA, which was a joint program between University of Hong Kong and London Business School, spending a majority of my time in Beijing, a month in Beijing and 8 months here in Hong Kong. And during that time, quite started getting involved, looking at the startup ecosystem here, which was in its nascency. I had done a couple of courses on entrepreneurship as well with the HKU MBA school. So it was naturally piqued about it. When I got back, I in a consulting firm known as Great Spark Partners, focused on risk and regulatory consulting on technology for tier one brokers. And that gave me a lot of exposure to fintech and blockchain. For example, Great Spark had released one of the earliest reports, probably the earliest report in the market 10 years ago on use of blockchain for capital markets, right? So that kind of got me involved into looking at how banks were transforming their processes, as well as on the front end for technology, in particular the trading world. While being there, I quite actively got involved in the fintech ecosystem in Hong Kong, starting off as a volunteer at the first fintech event, FinnoAsia's, I think it was called FinnoAsia event in 2015. We then moved to supporting the group of people who were the community in Hong Kong. 10 of us then co-founded the Fintech Association of Hong Kong. So I was part of the inaugural board, then took over as the inaugural general manager, running the association from 2017 till late 2019, where we built up over 1,000 members, individual members, as well as 300 plus representative organization. And that's where I really got an exposure to how technology was transforming the financial services industry end to end, from wealth banking, investment banking, all the way to payments, open banking, digital banking. The virtual banks were also formulated around that time. And I was, in addition to that, working very closely with regulators, government bodies, as well as other ecosystem developers in Hong Kong and in Asia, as the ecosystem was developing together there. And 5 years ago, I founded Finstep Asia, which is what my company is known as. We are a venture builder and a regulatory advisory consultancy firm focused on fintech and digital assets, originally formed to launch an accelerator for B2B fintech between India and Hong Kong. Then we had COVID. We then pivoted a little bit more so towards research, advisory, and events, and hence my Twitter handle of Fintech Ballerina. And in 2022, as you mentioned, I got that opportunity to join VARA, the world's first crypto regulator, and moved to Dubai for a year and a half. In addition to looking after the market assurance piece, I was looking after the grandfathering of legacy virtual assets operators in Dubai onto the licensing fold. And now I'm back in Hong Kong. Been a couple of months since I've moved back, and we restarted Finstep Asia, focusing, as I mentioned, again on the regulatory advisory and go-to-market between Hong Kong and the Middle East.
Quite a path you had. I mean, I'd like to talk more about your time as regulator, but tell me, what is it about this field that attracts you? I mean, you're coming at it from a very unique vantage point, and there are people in fintech and crypto writ large that they're coming at it from a business background or a legal background or a trading background, operations or what have you. But you're actually a techie. You have an engineering background. you have an appreciation for the technology that undergirds it that perhaps most don't by virtue of their background. I mean, they can't. I mean, if I were to use an analogy, then you can open up the grandfather clock and actually look inside.
Yeah, funnily enough, right, I just want to clarify as well that my engineering degree was in industrial engineering and management. We did have,
okay.
So the minor was in management, the major in industrial engineering.
Okay.
So from a technology perspective, yes, an exposure to, the basics of electronic and computer engineering and information technology. Being from Bangalore, as the cliche is, we are the IT city of South Asia, probably, and competing with Shenzhen as the IT hub of Asia. And so the exposure to information technology was very much there. But I wouldn't say that the attraction to me for both fintech and crypto was purely on the technical side or the technology element. I think it was more to do with newer models, right? As I mentioned, as an electronic trader, I was in a phase in my life, I was in part of the phase in the financial services world where physical pit trading was transitioning towards electronic trading, right? I got this amazing opportunity to go to the New York Stock Exchange floor 10 years ago or so. And it was remarkable to see that now all those pit traders had been replaced by computers, right? So it was a transitionary time, but you could see how important technology was for us. We were trading based in Asia into the US and European markets, and 300 milliseconds was too much at times. So even if 100 milliseconds would make a big difference to my decision making in the market from time to time. So when I saw the startup world evolving, it was an interesting element for me to be part of. It was more entrepreneurial interest about newer trends in the world, about how the business models were significantly changing from what they were previously, right? The classic comparison going back to the pit trading versus electronic trading is pit trading, besides having this understanding of a certain product, be it bonds, be it commodities, FX, or equities, was a lot about reading the room, as they say, right? Understanding who are the other traders in the room, which organizations do they represent, what is their face like right now, are they happy, sad, how have they been performing over the last few months, right? So there's all these, you had a lot of visual clues as part of your makeup to take those decisions, right? Your subject matter, and you didn't have news flowing 24/7 next to you while you were trading or immediately. It was filtering through, so you didn't have that exposure. Whereas on the electronic trading side, it was a lot about just looking at numbers. You had no clue about who's on the other side. So the visual clues from perspective of reading people went out of the window. You now had to develop new skills of looking at data, looking at charting, thinking about fundamentals, taking longer calls, but a lot about just seeing bid offers change on the screen. So when we extrapolate it to fintech, it's or digital banking as well, it is a very interesting conversation of how payment models have changed, from going from hard cash and to trusting online models. And we can talk more about the Hong Kong ecosystem later, but that's one classic example. And then when you look at cryptocurrencies, there's the other element of cross-border, in some senses, very seamless, instantish transfer of money, right? So those, I would say, is what attracted me to it. And being with Great kind of gave me the appreciation of how regulations impact financial models significantly. And a classic case is we were speaking to a very large international bank, and this was a head of markets, and we were just having a conversation, and he was mentioning an experience that he had where in Indonesia, new data laws had come into place, and the local compliance team had said that, this may require, a complete rehaul of the processes and may require a multi-million-dollar investment, right? And he went into looking into deeper, and after a couple of weeks of analysis, they figured out that, in fact, they didn't need to rebuild or build a new infrastructure in Indonesia because the regulations would allow for the ability to function from overseas, but be present the data on demand to the regulators, which then meant instead of being multi-million dollars, it was just about a few $100,000. What I'm referring to here is the classic understanding that regulations make such a big impact on the pricing and flows in banks. The second example I want to give is when I was with the Fintech Association, and this is during the early days of the HKMA's sandbox, right? So we met one of the banks who had done a POC with the HKMA, and we were just talking about why has there been such a long time for implementation of eKYC, even though the products were out there. The whole conversation was about the HKMA being prudent and wanting to ensure consumer protection, was wanting to ensure that these technologies that claim to do eKYC and validation on digitally were able to do it appropriately, right? And so as the bank had to get into the POC to largely showcase how they are able to distinguish between fraudulent documents or IDs using those vendors that they have before the HKMA then allowed it for them, and then broadly for the rest of the market, including to allow for your customers onboarded from international markets, right? So I think these are examples which tells you about how, from physical markets or physical transactions and engagements in the banking world, finance world, we now have the impact of technology. So I kind of build on top of that, and I feel that has enriched me to understand not just from being a finance person, but also to get this understanding from where the regulators may be coming in from, an appreciation for large corporates, not protecting them or saying that they've been beacons for innovation. For a large part, they not necessarily were, but just the appreciation that I feel is lacking sometimes in the fintech world of the regulatory challenges that some of these institutions face before they can go fully untethered, like some of the startups do when it comes to technology.
Multiple things that come to mind when I hear you say all of that. I mean, certainly when it comes to pit trading, it's a full contact sport. And what you say about there were skills that were needed back in those days, that being able to read the other players, being able to read the pit. Certainly, when I think back to even 2 decades ago when I was in graduate school, at that time, the Chicago Board of Trade and the CME had largely moved to online trading, but the banks did not want to give up their seats on the floors of the exchange because they felt there was an advantage to it. With the open outcry system and being close to the action, the sense was you had a feel for the market, a sense on the pulse that you don't get when you're detached from that environment, from that milieu. I don't know if there's a ready reception for that argument anymore in the age of digital, that given how far we've come along.
There is actually, fully speaking, yeah.
And the way COVID seemed to say, no, you can do your trading online,
yeah,
and the sky will not fall.
Yeah, it's funny you mentioned about the proximity, right, for the open outcry and how the banks wanted these seats. What changed? If you even look at Hong Kong Exchange, for those of you who may be familiar with Hong Kong Exchange, happened to be among the major markets that moved from pit to fully digital, quite late on, meaning the pit was converted to being a space for the brokers to sit with their computers. One of the funny thing that is a conversation in electronic trading is proximity to the exchange's servers, right? So you then had this the element where both hedge funds and banks were keen to get as close as possible to the servers of the exchange, so they could, literally have this difference of milliseconds to nanoseconds in some cases. But even if they're gaining 2 to 4 milliseconds, they would want to get this, and sometimes we're charged. MiFID II and a couple of other regulations broadly have tried to restrict that in terms of equal access to all players, but you do see that rush to meaning very close to the exchange building so that you can electronically get it slightly quicker than the rest of the world.
Yeah, and they paid a hefty premium to get that little extra edge. I mean, certainly this is a discussion from a decade ago, because I don't see too many people having that discussion now. But you touched on several things. So when we think of the evolution of fintech regulation, I think as you've described it, it's past its nascent stage of innovation. So it's no longer all that new. I mean, it's no longer the glamour, the initial fanfare have died down, especially when you think about how when, the initial white paper that for the basis for blockchain came out in 2009. So it's not that young anymore. Yet innovation continues. So with that in mind, what do you see as the regulatory approaches taken by China, India, Singapore, Hong Kong, and similarities, differences, any key pronounced things that you feel are worth pointing out?
Thanks for that question, Ajay. That's probably at very close to my heart as the term goes, and I will ramble on this, keeping in theme with the podcast title. And
yeah, that's what we do here. So
yeah, so Professor Douglas Arner, who's a great expert at the space. I've learned a lot from him on the topics, and I've built my thesis or comparisons as well, given my experience personally here, but also looking at India. I think we look at regulatory approaches. You can broadly put them into 3 or 4 categories of how the evolution has happened, right? So I want to take in the mature developed market thesis, which applies to Hong Kong, and to a certain extent, you could say the same for Singapore, and then the emerging market approach with India and China, and then you have the others for in terms of leading stuff, but adoption taking time, so which probably will be UK. So I think the first thing to distinguish is when it came to regulatory approaches, you could see that most of the developed markets, you had the regulators applying existing regulations and trying to retrofit them onto fintech and, as an extension, digital assets over time. But that was born largely out of practicalities, right? So when you have to make changes to the SFO in Hong Kong or any laws pertaining to finance, that takes time. And Hong Kong can be fast, but even in other jurisdictions, it can take a couple of years, at least 6 months to a year, to formulate it, draft it, get it discussed, and then approved. And that is an important element that is missed in regulations, which was very prevalent globally and still is in a vast majority of markets, where you go through this process, and that can be quite long. Now, what changed was an approach that was championed, I would say, by the Financial Conduct Authority in UK, who kind of looked at a principle-based approach to fintech, right? Which was, they realized early on, if you can use that term, I mean, I say a lot of fintech and the modern day fintech, if you want to call it, is probably post 2010, largely born out of what came after the global financial crisis, where you had banks being unable to, most banks, as we phrase that, most banks being unable to really invest in technology, while with the advent of smartphones driven through, the likes of Apple and others, you now had a bigger reach and more services being offered to consumers with literally in the palm of their hand, right? So from a computer to literally the palm of your hand, which meant different business models, which meant, your tech fins and others were emerging quite strongly. So during that gap, you had the FCA realized that things can move very quickly. The pace of change can be quite fast. So they've adopted a principle-based approach, which I think has been followed very well with both Hong Kong and Singapore. I'm of the belief that MAS gets a lot of credit for the way they've approached innovation broadly in both fintech and as an extension digital assets. However, I would say HKMA is probably on par and in some cases probably also ahead. Like virtual banks, in Hong Kong had set it up and licensed before Singapore did, and Singapore had a few things they did before. But broadly speaking, the MA has had a vision, has had strategies from the 7 smart banking initiatives in 2017-18 all the way to now the the major fintech initiatives part 2 that they're driving, right? So that approach of principle based was quite useful for these developed markets where the population wasn't necessarily heavily digital in finance, right? What I mean by that is, as much as you have high penetration of mobile phones and smartphones in Hong Kong and Singapore, there was a case to be made 4-5 years ago or even more that not too many Hong Kongers were using digital banking or digital payments. Octopus is ubiquitous across Hong Kong. Those who are not aware of Octopus, that's the travel card that the MTR in Hong Kong had issued decades ago and is also used for making small value payments, right? So up to 3,000 Hong Kong dollars, roughly $400. So you would see that, and credit card penetration is very high. So tapping your Apple Pay or just tapping your credit card would take the same time as using a e-payment fintech app, right? So the regulatory approach of driving innovation, responsible innovation, setting up license categories, which were different grades in some senses, like you have the stored value facility at a lower capital requirement and lesser licensing coverage versus the likes of the virtual bank, which is a full banking license that was brought up. So you had this approach, which slowly helped the consumer switch towards the e-payment and digital banking players because they got comfortable with it. They saw that there's a regulatory periphery around it and support, so they have more trust on it. Plus, some of the bigger name institutions got involved, like PayMe got involved and largely dominates your payments wallets with over 50% of the population having a PayMe wallet. And on the other side, you have the like Standard Chartered who have set up their virtual bank with Mox as the lead partner. So that's one approach. While the second approach that you can look at was how mainland China approached it. Now, mainland China approached it slightly differently, given that in China, it was a lot about enabling services, right? So if you think about Alipay, I would say it's almost incidental that they set up Alipay and it became what it became. But it wasn't planned to be, when it was started, the aim of Alibaba was not, let's become a payments player, as is well documented. Alibaba was an e-commerce player, right? Our own on the backyard of Chinese backyard and Amazon in its as per se, right? So when you think about Alipay, the origins, and I stand to be kind, but most of the origins were how can you enable better payment for customers with an escrow when they're not even used to e-commerce. So they need some trust. So trust is a major part of anything digital and technology. And so when they built Alipay, it was to enable the escrow element and enable better payment options for consumers, because quite a few of them, frankly, lack any internet banking, and a significant number did not have bank accounts at the time. So that kind of was a way to kickstart payments for Alibaba. And then that grew when WeChat came into the game around 2012, 2013, with gamification of the Hangbao, which is the red packets, right? So from a regulatory perspective, the Chinese regulators are more prudent or patient in saying, let's see how this develops. Is it having a positive impact on the market? And once it matures, then they brought in guardrails. For example, for some of the payment-related regulations for wallets, it took 7-8 years after the inception of Alibaba for it to, or Alipay rather, for it to come up. The time between inception of a certain model to the regulations coming in force reduced in terms of the gap or timeline to 3 to 4 years subsequently in the later part of the decade. But it did show that this was an approach. You also saw that with digital lending, right, which is the P2P lending. At one stage, you had thousands of P2P lenders, digital lenders in China. And then in 2015, 2016, you then had the regulations that came and then moderated that. And further down, just pre-COVID, there are a few more regulations which brought down the number of players significantly. But that was based on the impact it was having on the market. It also, at one stage, was a good enabler to provide easier credit to a wider field, which the banks were not necessarily able to or were looking to do. And you had a massive capital markets growth and banking growth in mainland China. So these smaller fintech players who are now giants were enablers at a time, and that helped. And so you can say that from a fintech perspective, the development was more private markets or the ecosystem growing with the regulators essentially allowing that to happen while they were focusing on the core economy. When you take India, probably later than the rest, you saw an approach which is slightly different, which was the government and came in with sort of digital infrastructure, right? So when you talk about the India stack, you see there are a lot of services from biometrics, Aadhaar, which is 1.2 plus billion people on it. The world's largest biometric program initiated at scale and at very, very minimal cost, right? So as a base, you now had digital ID. You then had a digital platform to which you could connect banking and payment rails. And the unified payment interface came into being and now is the largest real-time payment network in the world, right? Overtaking even the Chinese payment networks, which are more end-of-day settlement technicalities there. But long story short, you then saw this enabler from a government body and then the regulators allowing this to grow per se. And then now you're seeing the regulators kicking in with more regulations for consumer protection and to ensure a better supervision of these markets. So this would be like the broader approaches we've seen in Asia, and all three have worked because they were more tailored to their markets. And that's the lesson that you can say it's out there for the other markets for following on. That cost isn't really a metrics when you're coming to enabling fintech through government infrastructure, which India has shown. On the other hand, having prudence in terms of seeing the impact of technology on the broader market before deciding to clap it or ban it, which is what China did, is helpful to enable private market growth, but also newer innovation. And thirdly, if you're a mature market and you have strong fundamentals and good banking penetration, which both Singapore, Hong Kong, and you could argue the UK also have, you can then work off a principle-based approach to build trust on technology in your markets, which was the biggest challenge then, and which enabled, and in some senses, you could say, pushed the incumbents to also innovate, right? And that's why I say fintech is now redundant in the banking context or digital finance context, because it's now BAU for all financial institutions to be building digital services products, thinking about digital first in many cases, be it across financial products, right? And that is a big game changer versus they do compete against fintechs in certain segments, but on the payment side, what Visa and MasterCard are doing is pretty impressive turnarounds, right? So broadly speaking, any fintech that comes into the market now will need to be really transformational to have a major impact, while a lot of the fintechs are likely to be working with the banks and established financial institutions, which I also include the virtual banks, to scale and grow, on a network effort basis.
that will be the test. I mean, for a fintech to come along. I mean, then the question is how much really earth-shattering, revolutionary technology are they offering? You know, we look back to the dot-com bust. A lot of it was hype, more hype than technology. It was an interesting concept, but not backed up with all that much in the way of new revolutionary technology. But I imagine lessons have been learned, and just looking back on the last decade, that's been an incredible 10, 12 years, I'd say, where the banks have genuinely come around to crypto. They've changed their tune. But, even back in the day, it was clear that what they were saying in public did not measure up to their actions behind the scenes. And I'm not even talking about taking a position in the markets. I'm talking about, certain well-known banks that shall remain nameless were secretly building up their crypto teams because they wanted to be well poised to understand it and if it took off, which it did, to be able to capitalize on that. And so if we look at virtual assets, which I think you would agree have evolved in some parts of the world greatly, yet in others they're stuck in a gray zone, a limbo. Could you envisage cross-border regulation in APAC or even internationally evolving to the level of mutual regulation? Mutual recognition or common passporting, as was discussed a decade ago for investment funds in this region?
Theoretically, no reason why not, right? To that question of passportability and mutual recognition,
precisely a common APAC type passport. Once upon a time, they talked about it for the fund sector, and now they're talking about it for virtual assets.
And you've seen that in EU, right? Essentially, when you look at MiCA or MiCA, however you would like to pronounce it, is for a group of 30 countries to implement and follow. So it is theoretically possible here, but I would say that it is a challenge. I see more one-to-one or one-to-two, maybe, like mutual recognition to a certain extent. So let's say somebody gets licensed in Hong Kong, given common law and position as a financial center, you may be able to go into Singapore and the MAS will recognize that and may reduce your typical licensing time by 75%. Like there are some basic due diligence and requirements that are more local, right? As much as I would argue that 95% of all finance and fintech related regulations between Singapore and Hong Kong are identical, just given the nature of the markets to be a financial hub, and very similar from that extension to what are the regulations in New York, London, and in EU. So, broadly the big financial hubs. You would say that it is feasible and possible. And maybe the lessons learned from fintech is you didn't really see too much success. There has been success from a one-to-one perspective. You've had initiatives like the GFIN network, which was established for more so from a sandbox perspective or recognition of innovation, in some cases to expedite the licensing. I think there is an opportunity here in the virtual assets world for regulators to kind of say, hey, let's maybe build our internal protections, etc. Yes, but can we start early on this passportability element to eliminate, or never eliminate it, rather, take that back, but use regulatory arbitrage in a sector where there is skepticism for some legit reasons as well from regulators on the impact on their markets, be it capital outflows, be it money laundering, which are all there for traditional finance as well. But from an understanding, etc., it takes time. So maybe there is this need and requirement for that basis. Now, how will that shape out? I believe you've seen the work that both FSB and the IOSCO have done in terms of recommending principles for virtual assets and DeFi regulations, including also looking at stable coins. And you can say that could be a basis for most of these regulators, because frankly, most regulators haven't yet implemented or brought in crypto-specific regulations outside of the major markets, and most others are still using existing regulations of securities laws, in most cases for non-stablecoin use cases, and are trying to figure out where they can fit in the regulations. So that could be a barometer. The recommendations that came out last year, which were addressed to the G20 the group, I think would be very fundamental. And on the banking side and payment side, you see the work that the BIS is doing more on the innovation side, but that helps the central banks get a good understanding of what's happening in this space, be it limited largely to CBDCs and stable coins, but it does provide a way for the central banks to get closer to the subject at hand and implement more policies that are similar in principle, right? The finer details are always going to be a little more tailor-made for local markets, but there is that opportunity, I would repeat, for regulators. I do also appreciate the fact that I have seen a lot of regulators in the region and outside putting in an effort to educate themselves and understand more about blockchain and virtual assets. And there needs to be an appreciation of the efforts being put in. And hey, I may feel like a guy who's been on the regulatory front, so kind of defending or talking about regulators. But I was part of a regulatory regime that was natively crypto regulator, right? The first one. So it approached it in a very, with no financial services legacy per se as a regulator. It was like, this is tailored for the industry and you're making it for this industry rather than balancing things out. So that may be a bias that I may be having, but I would say what I'm trying to talk about is for the market to understand that most regulators globally come from a pure finance or legal background, compliance and law background, because that was very essential and fundamental for building regulations and running the regulatory regulatory markets, right?
But
now,
but haven't we moved past that point?
We have moved past that point, but if you think about evolution of digital finance and fintech, right, the pace of change of the technologies was not super rapid, right? And a lot of it was easy to understand, right? It's P2P lending. There's not too technical a conversation there versus understanding restaking as a classic example, right? From a technology perspective and how it works, the weeds of it is a little more challenging. I would say I've been in this world for close to 9 years now, and at times, there are many times, rather not at times, where I'm still struggling to understand certain new concepts or how things are being run, how the structures are. Some of it, you're overlapping between decentralized structures and complete decentralization in terms of governance and operation. So then, as a consumer protection, whom do you hold responsible? How do you manage that to protect your consumers who are going to get involved in this space, right? So what I mean by that is the regulators are putting an effort to learn and understand this, or certain teams will be learning and understanding this. However, it is a bit of patience that's required from the market, and also for them to try to reach out to regulators in their local markets to educate them on how things are before they start talking to them about enabling regulations, right? Till the regulators don't understand how things function and are comfortable with the way things are evolving, they will find it more challenging to regulate something. Because as difficult as it is to get a law in place, it is even more challenging to change that law, right? Hence, you have a lag in most financial services regulations when it comes to implementation of laws once a model is there, and hence during that time, typically the regulators tend to pause the business model. But coming back to your point, I feel, yes, we are beyond the technology element being newish to regulators. They have learned from their experience with fintech. However, blockchain and virtual assets broadly, I don't think has fully settled yet. There is a maturity in basic models, which is of understanding to most people. But in terms of the innovation, I feel there's still a few years more to go, and there are more layers, as it were, to be added to these to the blockchain ecosystem. So hence the patience is required and the outreach is required, because fundamentally I believe most regulators do want to have that conversation without the pressure of being forced to say, hey, make this easy for us, get this regulations going, get this regulations going. Talk to them, speak to them, make them understand how things are, and then they will enable regulations, because it's in the benefit of the regulator and government bodies to enable these models if they have a good understanding, rather than trying to constantly put them, shut it out, because keeping something out is much more challenging than to be able to manage it in a supervisory approach. Fundamentally, I believe most virtual assets, crypto operators have the right intentions, right? You'll always have bad apples. It's not just a crypto thing, it's a finance thing. You see bad actors everywhere. But fundamentally, most of them want regulations, because when you see a regulatory approach, you would then have something that you can anchor your business around, right? You may not agree with it fully, but you have something to anchor it with. And you have seen why Dubai has attracted a lot of newer players and large players as well into the region there, was because you had a virtual assets regulatory authority, which is crypto focused. And we are talking about regulations that were being built for the industry with strong prudence, strong risk frameworks, I would say much more stronger than on average. But it meant the dialogue that we had with the industry was very fruitful in shaping the regulations. And there was respect and understanding from the industry on why things were done. The consultation process that the MA and SFC and Singapore MAS, as an example, run before launching major regulations is a similar way, right? Understanding what the market wants. And so then these three cities and jurisdictions have become hubs for virtual assets because of this dialogue that's been in place, and having regulations actually is more enabling than any other reason. And I'm of the belief that if the US is able to sort itself out in terms of having clear regulatory regime around virtual assets, which got vetoed recently, but if you're able to do that, then the industry can build more clearly, rather than being stuck on different points of views and not sure where they fall. Once the clarity kicks in, people are happier rather than not. And those who are not will figure out a way to get into it. It's the same with fintech, right? How many new peer-to-peer lenders, or do you see how many investment players do you see who don't have a license? Now it's natural for anybody to say, are you licensed? I want to check your license. And you go to the regulatory website and check if this player has a license. So that gives more belief also for consumers, right? Yes, they are the crypto natives, the Bitcoin natives, some who are called degens or whatever there are, who prefer to have a wholly independent, decentralized ecosystem, not governed by government entities or government-related entities. But a vast majority of the ecosystem wants to have a regulatory framework that is enabling and also can support their objectives without hurting consumers, right? So the ETF for BlackRock is a classic example of how we now see a large number of financial institutions getting into investing in crypto and virtual assets through the ETF system. But because you now had a regulated product trading in one of the world's largest markets, or if not the world's largest market, and being driven by the world's largest asset manager, right? So all these have a big impact on how it enables consumers. So more institutions are coming on board. So long story short, as I was rambling on, I think the element is, if you have regulators who are well educated, they can then can develop and take more informed decisions. And that enables consumers, both institutional and retail, to come on board at scale, because the risk has been assessed and they have legal means of joining this ecosystem?
Certainly, what you said resonates with me in terms of the market, broadly defined, sees the value in having a sound understanding of the regulatory issues involved and how to deal with them when they arise. They see the value in having the regulatory regime down pat. And because otherwise, if you have regulators that aren't sure of themselves, they're not on solid footing, that can lead to, when things go awry, that can lead to overly emotional, overly knee-jerk, reactionary type, regulatory action, which no one wants. But the critique I've heard with regards to Dubai is that the industry likes it precisely because, kind of like with the formation of the Dubai International Financial Center, when a group of Anglo business interests told the Sheikh, we want our own sub-jurisdiction, our own, pocket universe, shall we say, within your jurisdiction, where we don't have to play by your rules and our rules, apply. We want that type of jurisdiction where English rules apply. There is a potential. There is a that poses its own dangers, and so the sense is that Dubai has gone too far in the direction of being overly accommodating, and you were there. You saw what the situation was. That VARA has a skeletal crew, and I'm just wondering, is that on account of there isn't that much to regulate, there isn't that much work, therefore no need to build such a huge regulatory artifice? Or is it more a matter of, no, we prefer light touch approach to regulation, so that's why we don't need that many stuff?
Right, so I want to start with qualifying that these are not views of VARA, they're my ex-employers.
Understood.
And so these would be my personal views. I'll counter this with two things, and I hear where you're coming from, right? So now, when you talk about DIFC, it is an offshore financial jurisdiction or hub, right? Been brought in to enable large financial institutions. And
I guess the point I brought that up because, in a sense, the view is that the industry is being allowed, maybe not Wild West type dealing, but the industry is being allowed to, in a sense, manage its own affairs.
I think on the counter. I actually think on the contrary, right? The pace at which Dubai moves is truly astounding. Right? Before I was there, I had no clue about how things move. But when a decision is taken, things move fast. But they're very approachable in the sense of they built an ecosystem, both in Dubai and the UAE broadly, where they look at challenges and say, how can we solve this, right? In a prudent way, in a way that is acceptable both locally but internationally as well, to allow businesses to thrive rather than just blocking everything out, right?
Then why is an up and coming newcomer like Dubai being eyed more enviously, more desirably by the industry of, no, let's go there, rather than Singapore or Hong Kong, which have more longer established jurisprudential traditions where you know what your rights are and you have an avenue of recourse, whereas the view is in Dubai, if something goes wrong and I need redress, I need the judicial system to come to my aid, my injury, that part is untested.
So look, I don't think the view is that way per se from a virtual assets industry in what I have seen. The first thing you can say, hey, Singapore had the PSD early on, and you had pretty decent number of crypto firms going there for licensing. Hong Kong's regime is just essentially kicked into place, right, with the VATP license and then the upgrade of licenses over the last 6 months to a year. Dubai's regulations kicked in early last year, right, Feb of last year. And you can see that from a engagement perspective, VARA, when it was dealing with developing the regulation, it was about ensuring that these are high quality regulations that are on par with international financial principles of major zones or jurisdictions, and to ensure that it wasn't seen necessarily as somebody coming in because they can get an easy license. That hasn't been the case. There have been more licenses issued earlier this year, largely because the people who had been applying for over a year were coming towards that end of that process of the due diligence that's required and the analysis that's required of their business models before the license is out. I think the attraction of Dubai is twofold. One being the element and the approach that was, let's approach from how we can enable this in a pragmatic manner, which is safe for the ecosystem, but also very safe for somebody who's going to be offering services overseas. As a pointer, if you are licensed in Dubai, right, you are subject to local laws. However, if you were looking to offer it in your services in an international jurisdiction or a different country, you would also need to abide by the regulations or requirements of that country, right? That is fundamentally there as part of the VARA regulation. So it tells you about how it's not just like, let's just become this offshore place where everybody comes and can get a license and then, not much activity. But this is about building ecosystem. It attracts people because the city as such has been very welcoming through COVID and other places for entrepreneurs and many others to come into the city, set up, very easy to set up and then build across. It's attracting talent from everywhere. And Singapore and Hong Kong, I don't think are too far behind per se, right? It's just different approaches. Hong Kong now...
but Dubai is also attracting cash in this space at such a high velocity.
It's attracting cash, it's attracting millionaires, it is attracting a lot of top talent, and I've been there, I can testify to it. When it comes to the comparison with Singapore, I think Singapore is a great hub for Southeast Asia and itself. Hong Kong is a great hub for Greater China and East Asia, right? So Dubai plays that role for the Middle East. And while the regimes in other places are being developed, it played because it was able to come through quickly. It was able to offer companies a licensing regime that is robust, that is respected internationally, that they can get and start working from, right? As we see the regimes get developed in Hong Kong and Singapore, you will see players having licenses in all of these jurisdictions or most of these jurisdictions, very much like how we saw fintech players doing that, right? So they were going to Singapore early or then Hong Kong, and then it took a while for them to go to other markets because it takes time to get licenses in some of the established markets, and that's about it. So I really don't see that as a major concern. Coming to light touch, I don't think VARA regulations are light touch. They're pretty robust, and what you could say is it has a scale in mind as your initial focus for the regulation.
Not in the way they've been written, but I mean implementation, enforcement. I mean, are the two necessarily the same?
Yes, so but there've been a pretty decent number of enforcement cases that have been done over the last 2 years. But you also got to keep in mind from a supervision and enforcement element for licensed entities and the broader ecosystem, there was a transitionary time period. You then have a team that is being scaled regularly, and there are more people added to the team as there are more license players coming in, more requirements kick in from a supervision and enforcement angle, right? So initial days was more on the regulatory framework, building up of the framework and on the licensing frameworks, and now we're moving to building the team towards supervision and enforcement, right? And if you look with our major regulators outside of Dubai, who are financial services regulators, right? you will notice that the teams that exist for virtual assets are not necessarily massive, right? They're part of intermediary supervision team or licensing team, but not necessarily a very large 100, 200 people teams, right? So they are also being scaled as the licensing frameworks increase. And I expect that will be the similar approach that may take place in VARA. This is me speculating. And I would expect that could be the way VARA also goes. Yeah.
This reminds me of a contingent from Hong Kong, and Finavision orchestrated it, or it and the Chamber of Commerce and the Fintech Association of Hong Kong were key to organizing this trip that took place. The Hong Kong contingent had government people as well, and some of those government people on the first night of the event in May of last year remarked how far in advance Dubai was and how far it had come in this space. And they were amazed, because part of it was, how can we convince more of these businesses to come our way? But also, we know what can we learn from what they're doing out there in Dubai. And this is a good segue to my next point, which was the potential in the region for building bridges for collaboration in fintech and in the virtual asset space between the Middle East and Hong Kong and China. Because, I mean, and even in recent times, we've had delegations going back and forth, recounting their experiences here. What does the future hold for collaboration between the Mid East and the Far East?
I think there's a lot of optimism to be had, and it's not just one way. I think it's going to be two-way, and collaboration is the right term for it. What you have, the fundamentally three things, right? One being the Middle East has strong economic ties with mainland China and Hong Kong. Secondly, you are seeing a significant diversification from a carbon-based economy in the Middle East, or oil-based economy, towards non-carbon but financial services. Innovation happens to be one of the major themes for this diversification, as well as sustainability, which is a major part of the Hong Kong focus, both from HKMA but also from the government. And thirdly, you are seeing these markets grow in size, right? And becoming more attractive for businesses in the Far East who are looking at newer markets. They've been to Southeast Asia, they've been to Europe, and now as they build out their service offerings internationally, the Middle East becomes attractive because you now have enabling policies. Dubai and UAE have been hubs for the Middle East for many years. Without Saudi, Qatar, Bahrain to a certain extent, and Oman as well, have been building frameworks and systems which enable quicker establishment of businesses, international businesses locally, but also to be able to connect to these companies and offer them incentives or packages or attractions for building the business when they land, right? So I guess from that perspective, there's a lot that may happen. There's a lot of learnings, as you mentioned, which mainland Chinese and Hong Kong businesses can take from their experiences in both fintech and virtual assets into the Middle East. Fintech, in particular, for mainland Chinese companies, who have done it at scale, but they've also done it in a market where per capita incomes could be comparable or at a scale similar to what's being done in Southeast Asia. So they bring deep expertise, have deep technology expertise that would be very beneficial for the ecosystems in the Middle East. And secondly, you are seeing the Middle Eastern regulators from SAMA to CBUAE, as well as the Qatar Central Bank, having launched multiple fintech, digital banking related initiatives, right? So yes, deep expertise here in Hong Kong with HKM, having driven that for many years, for that to be taken to that market. So there's a lot of collaboration between the regulators. You'd have heard yesterday the BIS Innovation Hub project Mbridge, which is on the CBDC side, not the fintech side, but was initially having 4 members, which is Hong Kong, UAE, Thailand, and PBOC. They'll now have Sama from Saudi Arabia as one of the core members, right? They have other observers, but that just shows you the connectivity between the regulators is also strong. So there will be the transition, or the flow of regulatory knowledge as well. But what that helps is you have experienced fintechs in this region, in the Far East, who can easily adapt to the regulatory frameworks that are being built out in the Middle East, because they have the experience of having gone through the processes here. So they'll be much quicker to market, right? So that bridge definitely is a high possibility. And there needs to be an awareness about looking at it slightly longer term. In some cases, businesses from Hong Kong and mainland China have had a lot of success and are used to things moving fast. In markets they go to, need to have the patience to build into a new market, because cultures are different, approach and dealing with digital finance is also different. Not necessarily that it's more behind or that people are more used to physical cash or others. It's just a different experience. So in Dubai, I could purchase even something worth $2 using my Apple Pay, right? So the samosa guy or the chai guy would just take Apple Pay if I needed to pay him that, right? So they are used to it, whereas they may not necessarily be used to other elements of fintech, enabling digital banking, which will take time to evolve. Like here, you have significant number of people are used to trading on their phones, whereas in Dubai, you may not have that culture. And Saudi, there may be a different world where the lending markets may have a different structure. So, and also these are Islamic countries where interest has a different structure when people follow Sharia finance, where no interest is used. So you need to adapt to those. So yeah, patience will be required by these companies, but the opportunity exists. Growing markets with the citizens of those countries having very high per capita, and understanding and openness to international businesses, which will enable these international businesses to grow faster. Now, the other element that many people look at is the funding world. I think there is definitely an opportunity for companies from here to look at getting funding from institutions or funds, sovereign or otherwise, in the Middle East. But it takes time to build that relationship, right? And they also probably will have a need of a Middle East business plan for these companies when they're going in for those investments from Middle Eastern funds, because there is a strong element of growing that ecosystem locally. So if you're getting funding, you probably would be looking to expand into that region as well. So that can take place, but it needs a building of relationship, and it's not going to happen over a couple of visits where you meet somebody for half an hour. It means you need to go in and invest your time over weeks, over months. Classic example, there have been a couple of Hong Kong companies who have done very well in the way they approach the Middle East. To one degree, I give kudos to Alvin Kwok and his team. They invested very heavily. They are an insurer, right? But they also have virtual assets related insurance. But Alvin spent weeks in Dubai. He has a team now in Dubai. And, they found the right opportunity in terms of the timing and seeing the market grow. They now offer beyond virtual assets. They've tied up with local partners. And, Alvin goes, I think, at least once a month, a week or two. So that kind of interest as well as dedication is required to grow in the Middle East. It's a bit like what I would say people need to do if they wanted to enter Singapore or Hong Kong. The local practitioners or institutions expect you to have a local establishment and entity and serving the local market. And only then do you get access to the major institutions. So if you're international, unless you're of good scale and size, it's more challenging. So long story short, very optimistic. From a government perspective, both governments have been encouraging the businesses and facilitating that through their teams. And from a business perspective, a lot of positivity. And I see cultural understanding also grow between the two regions and cities. As I do more trips back, I can see that happening, and I see more understanding of the ecosystem and appreciation of local sensitivities of the Middle East when I'm here in Hong Kong and discussing with people who have been there. Yeah.
I must concede that what's happening in Dubai, you're seeing a growth and a development of the overall ecosystem. That it's not just about traditional crypto. It's not just about traditional conventional services and solutions that people are offering, but it's about building an overall a larger digital economy ecosystem for the 21st century. That they've really seized onto that, and Hong Kong says the right things, but it does tend to take a slower, longer, more deliberative route, which some people say is a strength, and that argument has been made. But
I think it's also just structural, right? It's structurally different.
Yeah, when you've got centuries of jurisprudence behind you,
yeah,
you're not going to shake that dead weight that easily.
But it's also Hong Kong's policy approach to innovation, fintech or otherwise, from many years, and it was a very valid approach. Was it's industry led. Industry can lead it. We'll support it from behind, right? It wasn't you wouldn't
not just industry led, but wait and see approach. What works best in other jurisdictions?
Fair. Yeah,
we will take and tailor to local circumstances, and that did well for them, well throughout the colonial age, well into the first couple of decades post handover, but nowadays the buzzword, the watchword is dynamism. It's dynamic. It's responding to market changes quickly. And so if Hong Kong's being chastised with that anything, it's that.
Look, COVID kind of came in the middle of everything. Otherwise, I still stand by what I used to say, that Hong Kong had edged past Singapore in terms of approach to fintech and innovation when the virtual banking guidelines came out and the licensing process began in 2019, right? And I stand by that. Singapore, fantastic, dynamic, the way they approached it. And you could say the Middle East took a leaf from that to a certain extent. But the vision of Sheikh Mohammed, the ruler of Dubai, you could see was not, from setting up Burj Al Arab, which is an iconic hotel, to the Palm, to the world. All of those are part of the approach, and they've continued to do that because Dubai's had always had to look at diversification because they've not really have a large oil reserve. So they built on other things and made it enable us. So it's part of the ecosystem's DNA and the government's DNA there to be able to adapt very quickly and bring on board innovation quickly, right? So they recognize that. And Singapore also has that because they also needed to find a way where they can do different things, which locally they don't necessarily have natural resources. Hong Kong did that for a couple of centuries, as you alluded to, and now what we can see, and I'm very pleasantly I'm pleasantly happy about it. Of course, I'm going to use bad English, but I'm very happy to see the approach that the government as well as regulators have taken, not just from like a conversation and approachability, which they always were as being part of the industry body, and I'm aware of. You always found they were approachable. They were a lot of talks with the industry, which didn't make it to the main papers because these were behind closed doors. But now we can see the regulators present in many events, conferences, talking about what they're looking to do, speaking about enablement, HKMA's online strategy, or the posts that they put out, very well thought, very good. They should be applauded for the way they run it. And on the government side, from the chief executive, but more so from the financial services element, Mr. Paul Chan to the secretary in terms of Christopher and Joseph, all being there in events, showcasing Hong Kong to the world, and showing that when you have the government being approachable, being there at conferences, meeting people, it shows that, you're welcoming. And a little known or little paid attention to Hong Kong was always very easy. For the last 10, 15, if not more years, it was either number one or number two when it came to ease of establishment of business. And it still is, and it's not expensive. And getting visas, immigration isn't really as challenging, if at all challenging, for most companies, right? You can set up, you come in, you have a business. Yeah, you will definitely. Now the government has other schemes with the high quality talent schemes and other migrant schemes that they are bringing in to support international businesses and immigration to come in. So, which is actually a problem. Say in the UAE, it's not, but in many other jurisdictions, as a foreign business, when you go in, setting up a company is challenging, takes time. Forget about the regulated entities. Just general business would take time. You need any legal help, all of that stuff. Then when you're hiring people, you can't necessarily bring in a lot of talent from overseas, which you may want to based on your existing teams outside, but you had to do more local hiring, ratios of locals versus international, which are there in a bunch of markets. All these make a big difference, and Hong Kong has that ability. It's a city that has seen a lot of changes over time, and I think it's adapting. COVID probably put a spanner in the works in generally being able to accelerate this, and other jurisdictions also had that challenge. But now that it's opened up, to the approach that the government is taking is quite good. Virtual assets as well, right? As much as we say, virtual assets was a bit of challenge in Hong Kong, not really, right? You had an approach which was, HKB was one of the first central banks in the world to say Bitcoin is a virtual commodity, circa 2013, 2014, if I stand to be corrected on the timeline, but definitely.
Correct. And they said that they're not, it's not a digital currency, it's a digital commodity, and you trade them at your own peril, is what they said.
And SFC, when the ICO boom was happening in 2017 and 18, they did education campaigns on the MTR and bus stations, etc., talking to people about how it's challenging. And on the other side, they allowed exchanges to function as long as they were not onboarding security tokens, right? And that approach of being able to supervise, but also enable this ecosystem to grow while they were understanding it better and while they were reviewing the correct regulatory approach, which suits the city, but also the demands of international businesses, is commendable. And on the digital banking side, I mean, fantastic, right? Everything is fantastic from the way the MEAs run things, and with SFCs catching up when it comes to the securities world. And I have a lot of positive things to say. There may be a few things which are restrictive, things such as, say, crowdfunding or angel investing still requires licensing, etc. But that's in the prudence of how they see the market or lessons they may have had based on what happened in other jurisdictions. So they're going to take time on that. But broadly on the virtual assets world, I think it's been fairly well thought out, and there'll always be scope for improving on where they are. But given the size and scale of the market, I feel over the next 2 to 3 years, it'll be more enabling rather than more restrictive, as they understand the licensed players, as they understand what the markets are looking for. And we are more likely to move towards the real world asset and, what I call the blockchainification of financial services in Hong Kong than necessarily the DAO, the fully decentralized world being developed out of here.
But if one were to take the cynical approach, you'd say, okay, fine. Dubai's claim to fame from a marketing perspective, post 2003, and it's kicked into high gear after 0809, was always tallest of this, widest of that, deepest of this. They had to keep reinventing themselves. The novelty, they had to play at the novelty factor to show that they had something different to offer. Okay, let's set that aside for a minute. Hong Kong, Singapore, it's always been top down. It's always been state driven, and that's irked a lot of people in the private sector. And you saw that with fintech, you saw that with regtech. Hong Kong, progress more sluggish because, again, that they leave it to the private sector. The industry will come of age, will progress at its own pace. In an age where speed and execution are valued, then even though with Singapore, a lot of it is state-driven, is the ability to act quickly a virtue, even if it's state-driven?
Yes. I mean, the ability to act quick is very useful. You could say that. Dubai is the prime example of that. But it's very localized. The needs are very different, right? And people assume everywhere that everything needs to be done within 3 to 6 months. We need everything done. But in reality, it takes longer. Are you ready? A lot of these institutions who want to apply and want things done fast may not actually be ready to fully ready for something, right? To establish, be able to build up. I mean, I help companies who look to go to market in different parts of the world, into market in Asia, be it from East Asia into India or the Middle East or vice versa, or companies coming in from the West. But this vast majority of them are taking their time, putting one person in or hiring people like me to be their advisor locally for a few months to a year, 2 years before they enter the market properly with bigger teams, right? So why shouldn't that be the case when it comes to regulatory approaches and all of it? Because then it's a 2-3 year process as well. So that's something that there's the hype that comes from some broader industry people, personalities, and the demand for everything to be super quick and available. But, it's like, hey, here's fast food, or, the analogy would be for when people are talking about 5-minute, 10-minute delivery, like you do have an offer in India. And it's like, what is the utility of that? Or the vast, there will be a 5 to 10% of the population will probably need something in 5 to 10 minutes. But broadly speaking, most people are okay to get their shopping the next day, right? So it's that element, right? So you need to be able to offer something to the rest of the market and all the entire market. And in established jurisdictions, it takes a little while longer. So still faster than most. I mean, how many major jurisdictions globally have a crypto regime? Less than 24, maybe, if I think about it, right? And Hong Kong is one of those. So, yeah.
Let's come back to something you said earlier. The debate, and this is my own words, but earlier you spoke about stablecoins and CBDCs. The debate, as I understand it, is private sector stablecoins versus state-sanctioned CBDCs. The proposition as it's being put forward is binary. It's one or the other. I don't see it that way, but can the two coexist?
Yeah, I see it. I agree with you. It's not binary. They each have a different application. And I'll go as far as saying, except for maybe India and China, I don't necessarily see most of the jurisdictions doing much from a retail CBDC perspective. A vast majority of the jurisdictions are working on the wholesale CBDC piece, right? Which then means, from a cross-border nature of blockchain money, tokenized money, is going to be through stable coins. I mean, Hong Kong also has this consultation on it as a sandbox now for Hong Kong denominated stable coins, right? To see the utility thereof. It's just a representation of money. What helps is, depending on the use case, like the tethers in the circles of the world, they provide use cases where you can do cross-border transactions, trading, etc., almost instantly, and get remunerated or paid out in a similar time frame, versus it taking 3 to 5 days through the international rails, plus a lot more challenges when you're offboarding or off ramping, as it were, right? So, I mean, I'm talking about legit stuff, right? So it just is the easier way. I do believe as long as we continue to have challenges on cross-border payments, stablecoins will play a big role because you try to bridge that layer where people are able to have relatively easier access to stablecoins than they do to physical money or digital money as it were, and be able to transfer that cross-border. So CBDCs will run on their own. They'll be helpful for large trading use cases or for, government balances purchases as it were. Whereas stablecoins will have a lot more retail use cases, in my opinion. Yeah. Some stablecoins will also be used for these cross-border institutional use cases, but there will be a lot more retail use cases than institutional.
Certainly the anarcho-libertarian faction in the world of virtual assets, and they were amongst the loudest advocates, proponents of Bitcoin when it first came out. They certainly would like to see more use of stablecoins than CBDCs. They don't want to see the big banks and the government get involved.
No, but
yeah,
actually, to that point, Ajay, CBDCs aren't competing with Bitcoin, Ethereum, etc. Actually,
I agree, but it is their ideological fear and aversion that no, we don't want the state involved. Even though, like, I think it's clear they serve different functions, they serve different purposes, and the state will always have a role in printing the coin of the realm, which they need to understand.
Yeah, and it's also like if you take the Chinese CBDC or most of the CBDC projects, these are not your standard blockchain networks. Right? These are very highly permissioned networks with a lot of central control. No, it's not fully decentralized networks. So, and plus these are converting their, so vast majority of the transactions in today's world in terms of value occur digitally. Right? So it's just another form of digital money. There's nothing else to it. There is obviously more efficiency, operational programmability, all of that stuff. But that argument of we don't want CBDCs, they want, because it's state getting into digital money. Actually, the state's been in digital money for years, but now we're moving based on digital transactions. So it's not cash that moves, physical cash.
You see my point. Everything is a variation of a theme.
Yeah.
As I pointed out, there are articles I wrote a decade ago that, were I to tweak them, could run today, because in many instances we're dealing with the same problems, but in a different guise.
Yeah. So, I think that with programmable money in general and the blockchain and other elements, you get a lot more efficiency use cases, other things you could do. You were able to do some of these use cases using the existing rails, but not at the same efficiency or speed at which you could do. And now you're able to do that and think of newer ways of enabling. Restaking was a classic example of first staking and then restaking kind of gives you the element of how you can build newer structures on a financial rail, which is not necessarily possible at the same speed in the existing banking rails.
In the time we've got left, I'd like to bring this back to you.
Sure.
That in terms of your career as a regulator at VARA, that gave you such a unique perspective that few will ever have in their careers. You learned so much in such a short period of time. Tell us about that experience. What was the greatest thing you learned? How did that enrich your life and your perspective, and how does that affect how you deal with your clients now? What did you see when you got to look behind the curtain that opened your eyes, widened your perspective, broadened your horizons?
Look, my time at VARA was very enriching for me on three fronts, right? One, the amount of knowledge I gained in the space as well. I've understood the space, but going into the weeds of a lot of these different structures in virtual assets and how we approach the regulation for the same, right? And balancing the need for innovation with ensuring robust protection and risk. And it gave me a big appreciation of what regulators go through when it comes to finding that balance, right? So that was very, very useful, and it helps me explain it better to not necessarily just clients, but the ecosystem when I'm now on the other side or outside of a regulatory element. The second thing, look, I've never been to the Middle East beyond a 3-day stopover 15 years ago or so, right? And that was in Dubai, largely because I wanted to go to Ferrari World. And when I went back, it was the first time I was living, experiencing the culture, experiencing Dubai and how things have changed and what that city is. And you could say, right, and I say this with a lot of sincerity, is I really appreciate the impossible is nothing attitude that is in the DNA of Dubai, and how the approach is very, very refreshing. There's a big work ethic, strong work ethic among the government enterprises and the big key decision makers who put in a lot of effort and time to grow the ecosystem. And they're always approachable. There's like, okay, what are we looking to build? How can we do this? How can we enable this? The conversation of first this, largest this, all of that is more from an ecosystem perspective, right? It's because they've enabled it became the first. Because they enabled it became the tallest or biggest or whatever, right? It's because there was a vision enabling scale and the vision enabling speed. So that's a lesson that I carry, and I say the same, that they are approachable, they are quick on decision making, and they understand value very well in terms of how much value can this bring. If you're able to articulate that, you can go far as a business in Dubai. This is not a broader VARA conversation, but just broadly as Dubai. From a VARA perspective, was the approach taken to regularly engage with the ecosystem and also to keep the regulatory frameworks in a way that you could update them based on what you are seeing once they're done, right? So the classic example is the custody regulations. In Dubai, which probably is one of the only ones in the world at this stage, custody players need to be a standalone entity, right? It also enables protection which wasn't there during the FTX time, but if you're offering custody, you need to be a standalone entity. And that was one of the first licenses that were issued through VARA for custodians. Subsequently, you heard from the market, and also there was the development of staking through custody models. VARA looked at it, had a deep conversations with the industry, internally analyzed it, and then allowed for custodial staking after understanding the risks associated with it, after understanding the opportunity and bringing in conditions that ensured that the protection for the consumers or the users was strong, and you had consumer understanding of that product, right? So that's an example of thinking on your feet, to being able to listen to the industry generatively in terms of what they're asking for and being able to judge that. That was it still exists in the VARA DNA, and that for me is a big thing for the industry. When I was looking at grandfathering of the existing businesses, a lot of times it was also a discussion of trying to understand when some people may be on a gray, I won't say gray, but unclear area, right? To speak to them, and we would get feedback talking about how when we are discussing, we're able, because there are a lot of crypto natives, if I can use that term, or people who are very deep in the crypto world who were part of VARA. When we are having these conversations with businesses, you are getting more technical. You're able to not just look at a high level view. So that helped us be able to better structure the conversation, but also find the appropriate regulatory and licensing frameworks for these guys, right? So that's just what I feel is the lessons that can be taken from that. And for broader regulators in the region, they have had a lot of talent. They've invested in people who've gone out and learned about virtual assets, as they did when it was to do with fintech. And I would encourage those regulators who don't have necessarily local or in-house talent to bring in more experts. There are quite a few financial services people now who have had exposure to virtual assets over the last 5 years, if not 10 years. That's what one of the big strengths of Hong Kong is. People understand finance very well, but understand structuring, and now understand crypto very well. So bring those people on for other regulators to enable their engagement with the market being faster and better from the conversations to build their regulations.
That's true. That's true. That increasingly the worlds of conventional finance are merging more. They're not entirely removed. That crypto is becoming more mainstream. It'll never become purely mainstream, but it is becoming more mainstream, and it's no longer the odd man out at the cocktail party that exists on the fringe that no one wants to talk to, no one wants to engage with. So that is refreshing. And as far as Dubai goes, they've come a long way from the time where I spoke at the first Dubai Bitcoin event at the DIFC in December of 2014, I believe it was. Till, I mean, at that time, the only place accepting Bitcoin was, a pizza joint on Sheikh Zayed Road. Till now, I mean, and it seems to me there's been a greater uptake of crypto in that society. People seem to be more open to it, certainly than they are here, or certainly the people that I associate with here versus there. But one last question, though. Given the arc of your own career path and fintech, regtech, virtual assets, and increasingly, let me take a bit of a detour. What will Web3 and AI mean for financial services?
Very, very vast ecosystems, right? And I feel there's this revived interest in AI, but AI has been around for decades. AI has been used in financial services since the 1980s. Millennium Capital is a classic example. They were using AI then, and people still are. So you're just seeing evolution of AI, right? With Gen AI in particular, and broadly with Web3, I feel these two are going to be an enabler on their own, but also as a combination thereof. But that's probably the combination is probably 5 years away in terms of having an impact on the broader markets. There will be use cases and pockets of impact, but in the near term, it's probably more the impact that AI is going to have. It will change a lot of models. It will change how company structures are and the roles that people will have, right? Data has been the new oil for a couple of decades now, and you could say the nuclear fuel in some senses to everything we do in the modern world. And the underpinning elements of both blockchain and AI is data and the quality of data. And as that improves, the key element is going to be for AI, the regulatory approach that will be taken to enable companies to use AI in a way that it allows them to scale, grow, etc., versus balancing the risks that may come from AI, in particular answerability, or when AI goes rogue, right? Now, I'm not talking about a Hollywood-style AI going rogue. I'm just talking about programs going rogue, right? We saw that even with crypto. So then we rephrase crypto, say blockchain. There have been many instances where smart contracts were not properly audited or properly written, which led to failures and impacts later on. We've seen the same happen with the likes of Knight Capital when the smart algos were not properly updated, right? So, and there have been other instances where algos have gone bad, right? So the reaction time for something like that may not exist almost, maybe instantaneous, and the damage may be very quick. So the guardrails and the controls that will come around it, I don't mean controls in terms of controlling the development, but more protectionary controls for the impact of AI is going to be a big key on how financial services are able to adapt to it. The final piece to this is legal frameworks for both of them are lacking in many jurisdictions. So you had the financial services regulators come up with regulations, right, for buying and selling or transactions in crypto, but the element of property, right, or the the element of recognizing a blockchain transaction as a valid transaction, the rights of an NFT being legal rights. UK has discussed it. A few other jurisdictions have discussed it, but it hasn't broadly been brought into the legal ecosystem, if I may use the term, in most jurisdictions. And once that comes in, it will be very important. And similarly, when it comes to AI liability, I think is a major conversation. Who owns the liability? How do you control and protect people from AI that may go rogue or not follow instructions, or when AI is not used appropriately, right? So those things are going to be very important for the development of these two technologies, AI being more older technology, but for the wider adoption thereof, right? I'm not so much so concerned about the jobs narrative or the job losses narrative. I think we as a world will adopt and find newer roles that will serve this market, as we did when digital banking came around. Are there lesser number of bankers in the world now? Possibly, but are there lesser number of people in finance? I would say no, maybe more, right? So that's how I see it.
In the time we have left, is there anything you feel we didn't cover? Anything that you'd like to talk about before we go?
No, thank you, Ajay. I think it's been a very fascinating conversation, and thank you for giving me that opportunity, yourself and HKU, speak about my views and thoughts on a wide variety of discussions. If I were to have, as it were, the closing remarks, I think the key element for us is keeping an open mind for financial services and crypto on both sides, right? And collaboration is going to be the key for moving these industries forward, with the fundamental element that everybody looks for, which is trust, right? AI is also about trust. Nowadays, people start wondering when they see a video or a photograph which may be showing something that is not believable, or somebody doing, like, say somebody is a vegetarian, is having something which is non-vegetarian, as an example, right? They don't know whether it's AI generated or it's real, or some sportsman executing an action on the field, whether that's real or whether it's not, until they see proof, right? And so that is going to be important for us. So having trust as we build the ecosystem on both sides, both the traditionalists and the innovators, collaborating to enable the broader ecosystem is going to be the most important thing. Yeah.
And seeing as how you're a HKU alumnus,
yes,
and given our association with the law school, is there anything you'd like to say to the students? I'm sure a good number of whom will end up somehow involved in crypto or fintech or AI or Web3 in some form or capacity. And anything you'd like to say to them, either as users of these technological innovations and mediums of exchange, or people seeking careers in those fields?
I think probably more of them may be using or vested in the Web3 world than I am personally, right? I think the key thing for the students of HKU and even others is, when they are looking at a career, they will go through a few jumps, moves into different industry or different verticals of a industry. The key thing I would tell them is to have a bit of patience in whatever they jump into, be it Web3, blockchain, or even traditional industries, just to grasp and understand what they are about before you find it too complicated or no interest, right? We'll end up jumping from one to another without getting to have a decent appreciation of what these industries are. The second thing is that when you are approaching a career in a newer industry or newer vertical of an industry, you will need to be aware that there's a lot of learning involved. So you have to keep yourself constantly educated. And so your education is not going to end with HKU, and our top 16 university in the world. And very hearty congratulations to the entire HKU team for that. But
Thank you.
Broadly speaking, I think that's the key element, is you will have to keep learning and educating yourself to keep in step. And the future world is a lot about being able to be aware of what's happening. The technical skills will be useful, but technology may be able to take that away from you in the future. When I say take away, I'm saying they can code for you. You may not need to code. So just being able to learn how to prompt an AI coder for you is going to be important. So for that, you need to stay in touch with what's happening around. So that'll be number 2. And the final thing I would say is keep an open mind and be aware of your risk appetites. What I mean by that is when you get into the startup world, not all startups are going to succeed. In fact, most fail. But there's a lot of unstructured work, but a lot of more responsibilities you get. So you'll have a lot of excitement from that end. But if you're somebody who prefers structured way of work, more limited things to do, you may be more better off going to more established firms where there is a clear outline and structure and may not necessarily have the same excitement or the pace at which things move. So be aware of your personality and what you like. They both are great. It's just about aligning yourself to it rather than going to one place and feeling you don't belong there. Yeah, that's where I'd close.
Well put. Well, Musheer, thank you so much for your time. We must do it again sometime.
Thank you. It was a pleasure being there, and thanks again for giving me the opportunity.
Anytime. And to our listeners, thank you again, and until next time.